Let's dive right into this explainer. Today, we're unpacking a truly bizarre financial mystery. It involves a local bank branch, a vulnerable senior citizen, and a timeline that genuinely defies logic. And hey, to encourage us to bring more such content, please subscribe to the Paisa Files channel. Now, we're looking at a case that raises some absolutely serious questions about ethical lapses in bank-led insurance sales. Because, the glaring detail that sparked this entire uproar is a maturity date of the year 2124. You have to ask yourself, how exactly was a 90-year-old man sold a life insurance policy that matures in exactly 100 years? It's just wild. So, here is our agenda for today. We'll start with the year 2124, look at the exploitation of trust, dissect the anatomy of the mis-selling, review how social media struck back, and finally, discuss protecting our seniors. Okay, Section 1. The year 2124, a 90-year-old century policy. We set the scene over in Nagpur, Maharashtra. This involves Venkatachalam V. Iyer, a 90-year-old man who recently got a completely unexpected, panic-inducing bank alert, and the financial toll here was massive. 2 lakh rupees were being deducted annually from his savings account. So over the course of 2 years, that's a total of 4 lakh rupees for a life insurance policy that was only finalized last February. For a senior citizen, this represents a totally huge chunk of life savings, literally drained away under the guise of an insurance premium. Section 2. Exploiting decades of trust. The costs of loyalty. Now, what's really upsetting about this is how the family claims decades of banking loyalty were allegedly weaponized against him. Mr. Iyer's grandson-in-law, Saket, actually brought this whole incident to light. He noted that the Canara Bank branch manager framed this specific policy as urgent and very important, creating this intense, unnecessary pressure. They basically leveraged Mr. Iyer's deep trust in a bank he'd been with for decades. He was too old to even write properly, so he agreed, gave his signature without truly grasping what he was buying, and it caused him severe financial stress in his final years. Moving to Section 3. Anatomy of mis-selling, bypassing the rules. Let's actually look at how the bank allegedly structured this policy to bypass those strict age restrictions. Saket alleged this was, quote-unquote, cleverly done to mask the true nature of the transaction. Step 1, the manager advised Mr. Iyer to open a joint account with his daughter, specifically citing his advanced age as the excuse. Step 2, the life insurance policy was issued listing the daughter as the life assured. But step 3? This is the kicker. The 90-year-old remained the primary account holder, and it was his funds being drained to pay those 2 lakh rupee premiums. The family alleges the bank staff even filled the documents out themselves and just took his signature. So the whole thing really boils down to this stark mathematical contradiction, which, by the way, social media users spotted incredibly fast once the details went public. An ex-user pointed out that the absolute maximum entry age for this specific insurance plan is 80 years old. Yet the reality? The customer whose funds were targeted was 90. This glaring discrepancy strongly suggested a clear instance of mis-selling just to bypass entry age norms. Section 4. Social media strikes back. The power of X. Once Saket posted these startling details on X, including that absurd fact that the policy matured in 2124, the internet mobilized instantly. The outrage was palpable. Users were universally condemning the act, calling it a classic case of a predator preying on the vulnerable. But they didn't just get angry. The community offered real, actionable advice. They told the family to file a formal written complaint with the bank and the insurance company, and if it wasn't fixed in 30 days, to formally escalate it to the RBI and the IRDI. Because mis-selling to a 90-year-old, regulators take that incredibly seriously. And the sheer speed of social media accountability here is just astounding. The policy was originally sold back in February of last year. Fast forward to today, a premium alert triggers Mr. Iyer's panic. Hours later, Saket's X post goes absolutely viral. Now, initially, Canara Bank gave this rather generic response on X, just regretting the inconvenience and asking Saket not to share personal info, kind of dodging the specific allegations, right? But by Sunday, the regional head and the branch manager personally visited Mr. Iyer. The issue was promptly resolved, and they promised a full refund within a week. Section 5. Protecting senior citizens, the systemic issue. Taking a step back, we really have to look at the broader implications here regarding ethical lapses and protecting vulnerable citizens in bank-led sales. These takeaways highlight a deeply systemic concern.
We see the alleged manipulation of joint accounts being used as a loophole. We see how the relentless pressure on bank employees to hit sales targets can reportedly overshadow their fundamental duty to protect their oldest, most loyal customers. We see decades of trust simply exploited. But hey, on a positive note, we also see how powerful social media has become as a real-time accountability tool when traditional safeguards fail us. So, as we wrap up this explainer, I want to leave you with a critical question. Are aggressive sales targets putting our elderly at risk? How can we better safeguard our senior citizens from complex financial loopholes hidden within the very institutions they've trusted for their entire lives? It's definitely a sobering thought and one that demands way greater scrutiny of how financial products are sold to the most vulnerable among us.